Howdy, Jacob here. Today we're looking at our next company in our dividend yield screener, and this company is BCE Incorporated. All right, so let's look at some of the numbers here. We have a $36 billion market cap, 57.4 million enterprise value, good amount of debt, as we could see. BCE Incorporated is a diversified telecommunication services company out of Canada. 20 PE. All right, let's look at all this debt. Where is this coming from? 20 billion long-term debt increased a little bit last 10, 11 years. Let's see, 16. What is 20 billion compared to 3 billion, 2.5? It's going to be about seven times free cash flow, maybe 10 times, 9 times net income. So it's a good amount of debt. Let's see what the dividend is looking like. $2.80. $2.80 is over what they've made on an earnings perspective. Cash dividend, they're now paying 2.7 billion. Yeah, that's almost all of their money is just going out. Looks like they're paying for it with a little bit of stock issuance, a little bit of debt issuance. So again, we find a company that we just don't know the longevity of how long they can issue shares, issue debt before big bank starts coming at you and wanting their money back. So I guess we can start making some assumptions here. I mean, it's a huge company. They might have certain moat characteristics in general areas in their telecommunication services up in Canada because Canada is so vast. There might not be small enough companies, or there might not be small companies that want to have their services in such vast places, hitting a few people per square foot. But I mean, this is not growth. If we're looking at the last 11 years, it's actually declined. So, just for benefit of the doubt, I might do a classic 0% growth, 10 terminal PE. We're saying if they don't grow at all, then they don't deserve greater than a 10 price to earnings. 15% discount rate. I mean, their earnings and free cash flow are somewhat consistent. I mean, let's see, 13, 12. Let's do that. 12%, 13%. Share change issued, a little bit of shares, nothing too crazy. Let's go 0.5%. On the dividend side, I mean, I might do minus 2% a year just because their payout is just so high. I just don't see them keeping up with it. Down to 248. Even that, I don't know how they're gonna pay for, but guess still, let's be conservative here. They're gonna drop it 5% a year to something that can actually be more manageable, maybe a 75% payout ratio, which is obviously more than you'd like, but for a company that's not increasing and they're in the last part of their business cycle, it may make the most sense to hand it back to the business. As again, we can see down here, their return on invested capital is not doing much, so we don't really want them to put it back into the business. So I think that should be fairly conservative. So right now we're looking at a 1921 price to get a 15% return with these assumptions, and then current price is $39. It'd have to drop 51%. So it's definitely outside of the price point where I would even consider looking at it. There's too many other stocks, even in the first 10 videos, first 10 companies we looked at that look like a better deal for this if you're going to want just dividend income. monthly or quarterly. All right. I hope everyone has a good rest of their day. Thank you.